Hey, Bowtie Nation, Joseph Hogue with what could be the best way to look for dividend stocks to buy. You know, there's a lot of ways to look for those cash payments. We all love them, sometimes with dividends of 10 or 12% or more. But those monthly payers so often, especially for long-term holding those stocks, investors are disappointed because the dividend or the stock price just goes nowhere. That's why today I'm revealing 5 dividend stocks with the biggest dividend increases over the last 5 years. And more importantly here, the financials to send those even higher, to put more cash in your pocket over time. In fact, one of these dividend stocks on our list has increased its dividend by 56% just in the last year and a factor of 8 times over the last 5 years. Just imagine that, getting 8 times more of the dividend over 5 years. I want to get started on our first dividend stock here, Innovative Industrial Properties, ticker IIPR, but I'm going to show you how I found these and what we're looking for in these dividend growers next. IIPR is unique among real estate investment trusts, or REITs, in that it leases to companies in the regulated cannabis industry. Basically, the company has stepped in to meet that industry's limited bank funding to supply the real estate for grow and retail operations. IIPR owns 111 properties with 30 tenants across 19 states, and while that cannabis-related stocks have fallen hard over the last couple of years, I consider IIPR more of a real estate play than cannabis. That's because the industrial and retail properties owned by the company can quickly be reworked to serve other industries. So even if the cannabis industry continues to flounder and go nowhere, I think IIPR has some underappreciated properties here that could be revalued higher. I'm going to put all our stocks in here along with the dividend yield, the dividend increases, as well as some of the financials that we're going to be looking at. Very important, these financials that mean that not only has that dividend grown in the past, but it will continue to grow in the future. We can see here Innovative Industrial Properties, first on our list here, IIPR, has a dividend yield of 6.2%, a 5.5% dividend increase over the last year, which isn't anything to get excited about, just 5.5% increase over the last year, especially compared to another stock, our next stock, 56% increase over the last year. But really what we're looking at here is this 5-year dividend increase, this compound annual growth rate, okay, the average growth rate over the last 5 years, because 20% and higher is amazing. That's what's going to really make you more money over time. If we take anything close to that 1.2, 20% annualized over 5 years, take that to the power of 5 for 5 years, and we see that you will be making 2.5 times your dividend over in the 5 year period. Okay, so if they grow their dividend again 20% a year over the next 5 years, 2.5 times the dividend you're getting on that stock right now. We're also going to be looking at some of these other fundamentals here to make sure that they're putting more money in your pocket. Now, for Innovative Industrial Properties here, since it is a real estate investment trust, a REIT, I couldn't use the normal payout ratio or forward earnings growth for this. For a real estate investment trust, very important that you use the FFO, the funds from operations. That is a special calculation of cash flow for a real estate company, because these real estate companies have so much depreciation. You know, all of these properties, they depreciate them each year. That skews the earnings. So you cannot use regular earnings metrics like the payout ratio, which for a regular company would just be the dividend divided by the earnings. You can't use that for a real estate company. You got to use the funds from operations. I'm going to show you how to do that. But for Innovative and Innovative Properties, I went here to NAREIT, great data source here. We use this on our biweekly monthly dividend stocks data, but you go here to REIT data and REIT market data. You come down here to REIT Watch, and that is a monthly publication covering all the REIT industry. It's going to give you a lot of great facts, a lot of great data on these. Increase this a little bit so you can see it, and move it over here. And now what we want to do, Control F to find IIPR, and that's going to find you all the instances of that. We're going to go clear down here to the bottom where it gives us the stats tables, the FFO per share, FFO estimates, growth, payout ratio, very important. That's what we're going to be using here, as well as that growth estimate. Okay, so we come down here to Innovative Industrial Properties. We can highlight that one so we can see the data from there. Okay, so what we're looking at here is the FFO payout ratio. Again, for these real estate stocks, funds from operations, that is basically your earnings, but taking out a lot of the things that skew those earnings. So depreciation on those properties mostly. And we're going to be using that as the measure of cash flow for these companies that can support growth, that can support those dividends, things like that. We do see here that the FFO payout ratio for Innovative Industrial Properties is 93%. That might seem really high, especially compared to some of these other stocks that we'll look at. EOG Resources, for example, has a 36% payout ratio. So you would think that Innovative is that dividend is not sustainable. It's paying out 93% of its funds from operations as a dividend. If those funds from operations goes down, it's not going to be able to pay those dividends. If it wants to grow the dividend, it's not going to be able to. But what you got to understand here is that because these are special types of companies, these real estate investment trusts are special types of companies, if they pay out most of their income as a dividend, they get a special tax break. So that's why these are almost always very high. Now, when we're analyzing these, we do want to compare it against others. We do see that Innovative Industrial Properties is a higher payout ratio than a lot of those others in the space. 74, 61, 42 here for LXP Industrial, which I've also covered on the channel here before, but I don't think it's too much of a problem. We do have a 4.2% FFO growth. So that is the growth in funds from operations expected over the next year. That's going to support that dividend higher a little bit and support this stock. As far as the outlook on IAPR, I'm not really positive on the cannabis industry. It is just not competitive with your corner pharmacy there or your corner drugstore there on the corner. But this is more of a real estate story here with interest rates coming down. That is going to be supporting property prices as well as property owners. That's going to give us a property rebound. And you also get that lottery ticket if cannabis industries do take off. Okay, so I think a lot of these properties can be sold off or repurposed for regular industrial or retail use. And if cannabis does jump higher over the next couple of years, you're going to see that in the stock as well. And talking through that first stock on our list probably gave you an idea of what I'm looking for in these dividend growers. But I want to walk you through this step by step. And Nation, this channel has never been about just dropping a list of stocks in your lap. I want you to understand how I found these, how to do your own analysis so you become the better investor. Otherwise, you're always going to be dependent on some Yahoo on YouTube for your investments. You can see I did the calculations here for you, but to show you how I found these, we're going to go here to Yahoo, and to find these dividend growers, I first look for stocks with a 5-year dividend increase of at least 20%. You can find these if you go, I use the stock screener on E-Trade, makes it a little bit easier, but you can also find these by going to a stock's historical data tab here on Yahoo. If you change the time period here, you change the time period to 5 years, and then historical prices, you show this to show dividends only and click apply. That's going to show you the dividends over the last 5 years, the entire dividend history of a company. And that's how I used these 1 year and 5 year rates. Now, there's a little bit different on some of these. That 1 year rate is easy. You could take the most recent dividend. So here for Innovative Industrial Properties, you go here 1.9 in June. You go here to June 1.8. Okay, 1.9 divided by 1.8 is going to be that 1.055. Okay, so minus 1, it's 5.5%. Okay, but some of these is a little bit different. Okay, one thing to watch for in these companies that pay special dividends on top of a base dividend or more variable dividends. You see these with a lot with energy space companies like Diamondback Energy. So if we see on the historical data here for the dividends for Diamondback Energy, we can see this is very much variable. And if you look through a company's reports, you can see how much the base dividend is as well as the total dividend. Diamondback does pay a base dividend of around, I believe it's about 85 cents a share, and then a special dividend, whatever additional cash flow it can pay out to investors. You can see this through here. You can see that over the last 4 quarters, if I add this up, it's going to come out to $10.76. So 2.34, 1.97, 3.37. Okay, so $10.76 over the last year in total dividends. And that's really what we're interested in here, right? Is total dividends. We don't care what was a base dividend, what was the special dividend, or what. We want to know how much money we're getting in our pockets. If we divide that by what they paid over the year before that, we get that 56% increase in the total dividend year over year. Now to find the 5-year growth in dividends, so that's the annualized growth each year. You do the same thing except for payment 5 years ago. Okay, so we're going to take our Innovative Industrial Properties, the $1.90 per share dividend here in June 2024 that they paid out, go all the way down here to the September 2019, which was 0.78 cents. Okay, now, and again, this one with the ones that have special dividends or a little bit more variable, we took the last 4 quarters, added those up, and divided by the 4 quarters in the 5 years ago. But if we take this 1.9 divided by 0.78, we get a total dividend increase over the last 5 years. We minus the 1, so it would have been 143% increase in that dividend for IIPR over the last 5 years. That is very good. To get the 5-year rate, you go to this X to the Y key. That is the exponent. So you go to there and then 0.2. Okay, 0.2 because 1 divided by 5 is 0.2. So for 5 years, and you get that 19.5%. 19.5% annualized growth in the dividend over the 5 years. Now, of course, a history of increasing the dividend doesn't guarantee those higher payments in the future. And for that, we're going to look at these fundamentals, the cash flow and the finances, make sure that they are able to keep paying that or keep increasing that dividend in the future. But first, it does show a company with a heavy commitment to that shareholder cash return, one where a company has been managed efficiently to put more cash in your pocket. Combining that with the commitment and that commitment with the fundamentals that we are going to look at, just going to give you a higher confidence that those dividends are going to keep on growing. And for those fundamentals within the financials, we're primarily going to be looking at these two percentages. Okay, first here's the payout ratio. You see that here in the column here. That's the percentage of earnings the company is already paying out to meet that dividend. So how much of the earnings, the profits the company is making every year does it have to put out as the dividends? And conversely, how much is it keeping back for growth? Okay, so what can those earnings do to make the dividend still sustainable or still growable? You're going to find this by taking the dividend amount and then dividing by the earnings reported by the company over the last year. Now, again, for the REITs, for real estate investment trust, that was different. We had to go look at the payout ratio on that real estate report. But for the other companies, you can do this yourself. What you're going to do, you're going to add up the dividends over the last year. So if we go back here to Diamondback Energy, remember we had that $10.76. That was $10.76 in dividends over the last year. Then what we're going to do, we're going to go here to the analysis tab, and that's going to show us the earnings estimates and revenue estimates for the last year as well as this year and the next year. So if you go here and you can find the year ago earnings per share was $18.01. So I did the calculations here for you on the chart here. And I got the prior year estimates or prior year earnings for all of these companies right here. And we do find that if we divide that $10.76 by the $18.01 prior year earnings, we do get that 59% payout ratio for Diamondback Energy. Again, with all of these, you need to compare that against other companies or the payout ratio with other companies in the industry. Okay, just different industries are going to have different payout ratios that are considered safe, where they can grow the dividend and where they can keep enough back to grow the company as well. So with this Diamondback Energy, you're going to want to go into stocks like Exxon. You want to go into stocks like Devon Energy, ticker DVN, another one that we've covered here on the channel quite a bit. Compare those payout ratios to see who's the safer payout ratio, who has the lower payout ratio here. And of course, lower is better with the payout ratio because it means the company has more room to raise that dividend or just to sustain it. But there is a caveat here that I am going to explain next. Now, for most stocks, a low payout ratio like this 36% here we see down here for EOG Resources, that means the company is holding back plenty of earnings for that growth. Okay, so paying out 36% of its earnings in dividends means that EOG is holding back 64%, right? 1 minus 36% is 64%. That's 64% to reinvest or is going to be able to increase the dividend without a problem. Okay, it also means that earnings could come down and the company would still be able to cover that cash payment. Now, that caveat there is something that I already explained here. You can't always compare those payout ratios just side by side for different companies. Real estate stocks, like we talked about, will have much higher payout ratios because they get that special tax break for passing all their earnings on to investors. So that doesn't necessarily mean that 93% payout ratio is dangerous for IIPR, though it is a little bit higher than I'd like to see. Even outside the REITs, though, in regular stocks, companies in different industries are going to have those different levels of payout ratio that are considered safe. Morgan Stanley, we're going to see here, has a 71% of its earnings paying out as the dividend versus just 52% for Goldman Sachs. So if we go back to that chart here, we can see that 71% payout ratio for Morgan Stanley versus 52% for Goldman Sachs. So that would mean that we can say that Goldman is the safer dividend here, but not necessarily that the 59% payout ratio on Diamondback is also safe. Okay, for that, we really need to compare it against the payout ratio in its past, in the company's own past, and against other energy stocks to really make that call. Finally, before we get back to our list, I also want to look at the expected earnings growth for these companies. Those earnings, that's where the dividend is going to come from. So if profits or earnings aren't growing, then the dividend probably won't either. For this, I went back to the analysis tab. You can see here the analysis for Diamondback Energy. We already have the $18.01 year ago earnings per share in this column right here. We put that into our chart, And we also have the expectations for next year. We don't want to use just 1 year earnings growth. We want to get a little bit longer term time period of what the market expecting this company to make as far as earnings. We'd see here it's $19.99 expected for next year earnings. So we got our chart here, and I did put this in. Now you can see just a last day. It's changed over the last day. That does happen. Yahoo Finance has an automatic survey of analysts when they update their own earnings estimates, price estimates, things like that. They do automatically get changed in here. So it can change day to day. Hasn't changed a whole lot. So we're still going to use that $20.13 earnings expected for next year for our calculations here. So you can see here prior year earnings, next year earnings, and you can see here the forward earnings growth calculation. What this is you just go in here to your calculator. You take that next year's earnings growth, 20.13, divided by 18.01. Now that's the 2-year annualized or 2-year growth rate, right? 11.77% growth over the next 2 years to find an annualized rate on that. So a yearly average rate, you just, again, go to our little X to the Y here and then 0.5. Okay. So because 1 divided by 2 would be 0.5, right? So 0.5 is going to be your exponent. Equals, and then you get that 5.7. Okay, with these, you always got to minus the 1 out. So you get the 5.7% annualized earnings growth. Okay, so that's very important in telling us, okay, we've got the payout ratio. We know how sustainable that dividend is, but how much can it grow? Okay, a company with 5.7% earnings growth a year can't be growing its earnings by 50% every single year, right? It just wouldn't happen. This payout ratio would shoot up to past 100% and they wouldn't have the cash available. But it can be, especially with that lower payout ratio, the 60% payout ratio, it can increase its dividend a little bit more than the earnings growth each year. Okay, so we've got 5.7% over the next year. Not great, but and not as good as it's been in the past, but still, I think this dividend can go up 10 or 20% over the next year. Taking a closer look at that Diamondback Energy, a ticker FANG. Again, an oil stock we've had off and on here on the channel and have done really well over the last 5 years. You can see here where the price of oil really bottomed after the pandemic and how far this stock has gone, along with other favorites like Devon Energy, Dividend, Chevron, ticker CVX as well. And that dividend has really followed this stock price all the way up. You can see right now it is a dividend of 5.85%, which is very strong for these, non-real estate, non-BDC stocks. Okay, any regular dividend stock that pays 5.8%, it's something to watch. Now, Diamondback and other energy stocks have banked on that record U.S. oil production over the last 5 years, and no other area has really benefited as much as from that Permian Basin where the company has its assets. Lower oil prices have also weighed on the stocks lately, but the company is very well managed. It's turned just 3% increased oil production this year into an increase of 7% in the base dividend. So very efficiently run company. And we see here FANG is an industry leader in that cash flow generation, producing one of the highest cash flow margins in its peer group and just gets more out of its spending. This bottom chart here shows the company gets 41 times its capital spending in oil production. Okay, 41 times what it spends, it gets it back in oil production, well above the other companies in its industry. And that's the kind of efficiency that's going to continue to generate that cash flow growth and grow the dividends. So here we do see that dividend yield. If it was 5.7% yesterday, now it's 5.8%. Stock price has come down a little bit, and we see that 1 year and 5 year growth, the best in the group here. Again, with those higher oil prices, especially over the last year, especially over the last 5 years, this company has increased its dividend by a compound annual growth rate of 52% over that period. An enormous dividend growth. I obviously do not think we're going to see that here. These oil stocks have been weak since March on fears really an economic slowdown is going to weigh on that demand for oil. And the price we've seen lately has come down under $70 a barrel. That said, these oil stocks are very well cash flow positive, even at $70, even at $60 per barrel, and are going to be able to sustain that dividend. This is one reason why Diamondback Energy does have that base dividend and then pays out anything extra in that special dividend. So you're still going to get that base dividend. The price of the stock may suffer for the next quarter or two, and that dividend growth for sure won't hit 52% annualized next year, but this is the best oil stock for the rebound and it's still cash flow positive here. So it's going to have the best assets in the country. And I think this is the one to own in the energy space. We've still got 3 more dividend stocks to highlight and 3 stocks to watch, but I want to get your opinion on this as well. We can look at dividends a lot of different ways, from highest yields to the most years consecutive payments to the safest. the fastest growers like we're looking at here. But like the man said, you can't always get what you want. Now, maybe that analogy doesn't quite work, but it's the stone, so I had to try anyway. Anyway, you can't always get everything in dividend stocks. So what's important to you? What are you looking for? Let me know in the comments here. What are you looking for in most of your dividend stocks? The highest yield? Are you looking for the highest total return with dividends and price? Maybe just the most dependable or safest. So tell us and the metrics you use to find your own dividend stocks in the comments. We'll try to do some videos on those as well. Next up here on our list, Tronox Holdings, ticker TROX. You can see it's almost got a 4% dividend yield, so a little bit lower, but very strong dividend growth in the past. So again, might be low now, but if it keeps on growing at that rate, and I think it can do pretty well in the future here, you're going to get a lot more for your money. With $2.3 billion in revenue, Tronox is the world's largest vertically integrated producer of titanium dioxide pigment, a chemical used in pretty much everything from cell phone screens to paints and AC filters. So very much a stable demand chemical here. Being vertically integrated from its mines to processing means the company controls its own feedstock and can get that better control on pricing. Here you can see that dividend yield, 3.8, 3.9%, right around there. It hasn't grown in the past year, so that is a problem here. We did see 22.7% 5-year compound annual growth rate, so very strong growth rate, kind of showing us that commitment that management has to returning that cash holder share return. So this is probably the most awkward stock here, probably the riskiest stock, and maybe the one I'd buy last if you were just trying to decide which of these stocks to buy. Okay, just because it did have, we see that negative payout ratio because it did have negative earnings over the last year. So a little bit coming off of a trough in earnings, but we do see that forward earnings growth, that expected earnings growth of 786%. Again, we can go in here to the analysis, see what analysts are talking about for this company. We can see that it did have negative 15 cents per share earnings per share over the last year. We'd want to look into that to see why they had that earnings per share negative last year and why it's rebounding so much this year and next. And we got 42 cents this year, $1.33. We do see 11% and 6% earnings or sales increase. Now, this is the smallest company at just a $2 billion market cap and is exposed to those ups and downs in one specific chemical. So not only in that earnings variability that we saw, but also just the business fundamentally is riskier than a lot of these other larger companies. But that wide use for titanium dioxide is a plus. It is a very, very much a demand use case across industries and gives the share some stability with that. I do like the company. I think the company is riding its earnings slump, and we should see that return to a strong dividend growth. Next up here, Morgan Stanley. We're going to see in our table that the banks have just become cash flow machines with 35% earnings growth, but these aren't really like a lot of other banks, okay? With Morgan Stanley, and later we'll look at Goldman Sachs, we're talking more about the asset managers and the investment banks. It's in those business lines that have really helped insulate the two, these Morgan Stanley and Goldman, from really those interest rate and deposit problems you see with the other banks that we've seen over the last year. We do have the 5-year chart for Morgan Stanley here. You can see that not only has it increased the dividend by a pretty good factor there, it has also increased the share price. So you're getting a great total return there. In fact, when I was working with venture capital, it was always these investment banking guys, right? The investment banking guys at Goldman, at Morgan, and that we tried to beat in terms of returns and deal volumes. I'll admit, venture cap makes some very solid returns. We made great money there in venture capital, but the cash and just the deal sizes for IB is working that can be insane. You see here in our chart that 3.7% dividend yield is the 4th lowest on our list. But again, don't get caught up in these dividend yields, because if a company is growing its dividend by 10, 20% a year, you're going to be making a lot more of that just in a few years into the future. We can see that Morgan Stanley increased its dividend by almost 9% over the past year, 21% over the past 5. And again, to get an idea of how much that is, if you go 1.215 and then you do your exponent 5, that is 2.6 times. So over those 5 years, investors in Morgan Stanley saw their dividend grow 2.6 times as much as when they bought the stock. So that is something that's hard to ignore, even with that 3.7% dividend yield. The payout ratio is a little bit higher, like we talked about. 71% of Morgan Stanley's earnings are going to pay that dividend. That is higher than the Goldman Sachs that we'll see. And we'll see that the earnings growth, 21% expected earnings growth over the next 2 years, isn't quite as high as Goldman Sachs. So I would probably maybe defer to Goldman Sachs. It really depends on what you want in your dividend yield, okay? That Goldman Sachs dividend of only 2.4%, really doesn't qualify it as a dividend stock in my book. I want to see a dividend yield of 3% or more. But if it is growing its dividend faster, if it is going to be able to do that faster in the future as well with these earnings, with these forward earnings expectations, then maybe you want to give that Goldman Sachs a look instead. I'll show you that next dividend stock and the three I'm also watching, but I realize these dividend yields in this video might not trip your trigger, even if they are growing them by double digits a year. For the highest yields I've seen, check out this video and see how the QDTE, that weekly dividend fund, is producing a 62% dividend and paying it on a weekly basis. Got another energy stock here with EOG Resources, ticker EOG, though it is different from a lot of the other oil stocks we're looking at. I'm going to show you why in its business model here. We can see the dividend yield of 3%, a little bit lower than we'd like to see, but with that price return and what I think can be very good dividend growth over the next couple of years, I think this is one definitely to look at. That's because EOG is one of the largest natural gas producers with operations across the United States. Now, while the company does produce some oil, natural gas production of 10,000 equivalent barrels a day, or about 85% of its total volume, makes this one almost a pure play on gas. While the price of oil has held up against that record production, the price of natural gas is down nearly 40% since late last year. That's because a mild winter heating season last year, really along with record gas production as kind of a byproduct of oil drilling. So when these producers, they drill for that oil and they produce oil, out comes some natural gas and they bottle that up and sell that as well. All that drove those natural gas inventories to 40% above the 5-year average this year. That really crashed the price. Now, a drop in production by some companies, including EOG, and hot summer cooling season has helped to bring those inventories down. But again, they're still well above the average, and another warm winter this year would be very bad news for these producers. That said, EOG has worked to become more efficient, having its price required for that 10% ROE on oil and bringing down to just $2.50 per million BTU on gas. That's helped to increase its free cash flow even on this lower prices and sustain that dividend. Here we do see the dividend yield was 3.4% just a couple of days ago when I put this data together. The price of the shares has come up a little bit, so the dividend yield has come down 3%. Good for investors that own the stock, though. Price has come up. Still an excellent dividend increase over the last year and 5 years. We see 22% increase in the dividend over the last year, 26% annualized over the last 5. So despite that weakness in natural gas, the company has become more efficient, been able to send more cash back to investors. We do see the payout ratio very low, 36%. In fact, one of the lowest payout ratio on our list here, much lower than Diamondback Energy, the other oil company on the list here, 36%. That means that EOG is going to be able to reinvest in the company, keeping a lot of earnings growth or earnings back for reinvestment in growth. And it's also going to be able to increase that dividend. Even if those natural gas prices stay lower, it's still got plenty of room there in the payout ratio. Forward earnings growth, the earnings expected over the next 2 years from analysts, not great there at 3.7%. Obviously, that's going to hamper or hinder what the company can increase as far as dividends, but it's all really the short term. The outlook depends on this winter. That's because a cold or even normal winter can see a lot of that gas inventory cleared out, and the recent production cuts announced by a lot of these companies, including EOG, could turn the market to a deficit fast, which would in turn spike the price of natural gas and stocks like EOG. Another mild winter would see inventories build and the stocks suffer here, but this is a best-in-class producer, and natural gas demand is growing with that renewables use. So longer term, we should see good cash flow growth and dividends from EOG. Other 3 dividend growers also made the list for a few different reasons, though they didn't have that yield that really makes them a dividend stock in my book, right? Again, I always like to see a yield over 3% on my dividend stocks. On the other hand, if they do keep growing that dividend at this 5-year rate, in a few years, you could be collecting a dividend yield in the double digits on your original investment. So we've got stocks like Goldfields Limited. Gold prices reaching record highs here. These gold companies are very strong cash flow positive. I don't know why they're only paying out 2.8%, but they have grown it by 30% a year. One of the highest 5-year growth rates on the list here. Only paying out 42% of their earnings, so plenty of room to increase those dividends, and a 40% expected earnings growth over the next 2 years. Okay, so we're seeing those those high gold prices come through in the earnings for these gold companies. 40% earnings growth, I guarantee you they are going to be increasing that dividend, especially more than they actually did cut the dividend over the last year. We'd want to look into see why they cut the dividend slightly there, but 40% earnings growth over the next 2 years, they're going to be able to increase that dividend quite a bit. Ares Capital Management here, ticker ARES, also made the list, only 2.6% dividend yield, but very strong 1 year and 5 year rates. This is a BDC, so this payout ratio is a little misleading here. Those BDCs, like the real estate investment trust, have to send most of their cash flow back to investors as dividends, so they keep very little left. The 101% is a little high, but it is sustainable here with the 25% earnings growth, as well as some of the other fundamentals for the company. And of course, Goldman Sachs, we've talked about here, a 2.4% dividend yield, the lowest on our list, but very strong 5-year dividend increase. Very low payout ratio, even compared to Morgan Stanley there, and that forward earnings growth of 35% a year. Going to be able to increase that dividend quite a bit. Check out the video on the right to see how the QDTE is producing a 62% dividend yield and putting cash in your pocket every single week. Or look in the description below for other dividend stock videos that you might like. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.